Hi there. Thanks for stopping by the Equity Trust Virtual Classroom. My name is John Bowens, and in this segment, we're going to be talking about the three most common myths that I find with investors who are looking to invest in precious metals such as gold and silver with a self-directed IRA, self-directed Roth IRA, or self-directed solo 401k. The first myth is that there will be some sort of adverse tax consequences or penalties for investing in physical metals with a self-directed IRA, Roth IRA, or solo 401k. That's so far from the truth. In fact, what you'll learn is as long as you follow all of the rules properly and you work with the right partners, you can effectively invest in precious metals in a tax-exempt, tax-deferred, or tax-free environment. Think of it just like investing in a stock or mutual fund. When you buy a stock, cash leaves the account. In return for that cash is a stock certificate. When you invest in metals, it's the same process or similar process. Cash leaves the account and is sent directly to a metals dealer. That metals dealer then ships the metals directly to a depository. Nowhere along the way have you physically taken receipt of the cash or physically taken receipt of the physical metals. And so when you move money over from another retirement plan into a self-directed IRA, as long as you're doing it properly, there's no tax liabilities or penalties. And so as long as you make the investment into the metals and store them properly, there's also no adverse tax consequences. All right, that leads us to myth number 2, which is I can only roll over or transfer funds one time a year from one retirement account to the Equity Trust self-directed retirement plan. What folks are referring to when you hear of this only once in a year rollover transfer, they're actually referring to what's called a 60-day distribution rollover. See, if you take a distribution from a retirement plan, there are, yes, tax consequences and penalties. But if you simply initiate a trustee-to-trustee transfer, like a bank-to-bank transfer, or a direct rollover from an employer plan, like a 401k, if you do a direct rollover or an IRA to IRA transfer, you are not distributing the money. Therefore, you're not bound to the 60-day distribution rollover rules. So the 60-day distribution rollover is where you take active receipt of the money, and then you have a 60-day window to return the money to a qualified retirement account. That, yes, you can only do once in a 12-month rolling period across all of your IRAs. But that's not the way you'll likely fund your self-directed IRA. You'll initiate a direct rollover where you'll never touch the money. It'll go directly from one bank to another, to Equity Trust, or you'll do an IRA to IRA transfer. As long as you're doing a direct rollover or an IRA to IRA transfer, you can do that as many times throughout the year as you'd like. All right, last but not least, myth number 3 is that I can hold the physical metals in a safety deposit box in my name or at my own physical residence or at a business address. You'll find that Internal Revenue Code 4975 would deem this a prohibited transaction. You cannot furnish goods, services, and facilities between the plan and a disqualified person, 4975C1C. You cannot derive a personal benefit. There are rules that we are bound by, and we have to respect and understand Internal Revenue Code 4975, and that we cannot take active receipt of those assets. So that's why it's absolutely imperative when using a self-directed IRA that we're working with the right individuals. We have a metals dealer that we're acquiring the metals from, and then those metals are being shipped directly to a depository. So we're never physically taking active receipt. That's the terminology. We're not taking active receipt of the cash or the physical metals. Therefore, we're not engaging in a prohibited transaction. So very important to understand myth number 3 there, because I do understand that there are some folks out there that might be promoting the concept of holding physical metals ourselves. Remember, you are a disqualified person to your IRA. So if you physically took receipt of those metals, that would likely be considered a prohibited transaction, which would result in your IRA and its assets being distributed in the year in which you engaged in that prohibited transaction. And of course, we don't want anyone to fall victim to those issues. I hope you enjoyed these 3 myths, and you're getting a better understanding of how to invest in precious metals with a self-directed IRA, certainly I'd encourage you to check out our YouTube channel. We have additional information and education. Again, I'm John Bowens with Equity Trust Company, and keep leveraging compounding interest in the absence of taxation.